Welcome, everyone. You are joining me, Jessica Medina, for another Zoominar. Today, we have the fabulous Lauryn Williams. She is a certified financial planner, but even more interestingly, a four-time Olympian. So we're going to get into that a little bit. Every month, we do Zoominars on financial topics, and this month, it's talking about tax strategies for student loans. We talk a lot about student loans around here, but we don't always get into some of the advanced and more complicated topics related to them. So I wanted to make sure to invite Lauryn in to talk to us so that we can figure out how we should be thinking about taxes while we're also thinking about student loans and our repayment strategies. Just for anyone who doesn't know me already, I'm Jessica Medina. I am a former lawyer turned accredited financial counselor, and I help attorneys figure out the money so they can pursue their true passions, whether that's in law or not, and no matter the salary. And just some housekeeping issues for today. This is being recorded, and the recording will go out tomorrow. So if you're not able to stay the whole time, don't worry, you're not going to miss anything. We will make sure to get that out to you tomorrow. And we can take questions if you want to pop them into the chat. I'll keep track of them, and we'll try to answer them at whatever time seems relevant during the conversation. And at the end, I'm also going to open it up in case anyone wants to ask personal questions of their own situation of Lauryn while we have her here live. Sometimes typing it all into the chat is a little onerous, and you can just get into a little back and forth with Lauryn. I know she would love to do that. But just remember, this is being recorded. So if you take yourself off a video, it's going to be going out with the recording tomorrow. And like I said, we do talk a lot about student loan debt around here, possibly because I just finished paying off the $200,000 of loans that I graduated with from law school. And I know there are many people in my audience who are in similar positions on similar journeys, and thinking through these complicated issues while you are on a repayment journey is so important. And that's why I'm so excited to have Lauryn with us today. Again, like I said, Lauryn Williams is a four-time Olympian, a certified financial planner, and a founder of the financial planning firm Worth Winning. And she's also a consultant with one of my favorite shops, Student Loan Planner. So Lauryn, welcome.
It is so good to be here, Jessica. I can't wait to chat with you and the community.
Excellent. Well, you have an amazing story. Before we even get into the money stuff, you have to give us a little bit of background of how you ended up where you are, doing what you do, given what you've done over your life.
All right. My long story short is I was 20 years old and I became a professional athlete. Did not have a goal or aspiration of becoming a professional athlete. Just kind of fell in my lap. I was trying to get the free education that came with the scholarship for being, doing track and field in college. So I saw Sarah as a fellow Hurricane. So yes, go Canes. So as a junior in college, I ran the second fastest time in the world. And it just so happened to be 2004, which was an Olympic year. So I had to turn my focus from being a junior in college and running track to representing Team USA, navigating contracts and agents and all that kind of stuff. So as a junior that was a finance major, I felt this pressure of, I have to know stuff about money, but they didn't teach us anything about personal finance. In fact, financial planning was not even a major at the time that I went to school. So it was like, how do I figure out this whole money thing? A family friend introduced me to a financial advisor, and that was kind of the opening of the door, if you will, that got me on this road to financial planning. So I think so often in our lives, like I said, some of our negative experiences lead us to something more positive down the road. So first guy sold me a bunch of products, investment products, didn't really help me with basic things. So like I said, at 20, you just don't have life experience. I didn't know how to make a budget. I didn't know if I could move out from living with my college roommate. I needed to pay taxes because I was an independent contractor with Nike. All these different things I'm trying to navigate. And it was like, here's $1 million of life insurance and here's an investment account. And I'm like, don't feel very clear on what I'm supposed to be doing with my life. So long story short is that I fired that guy, hired another one, thought that was going to go better. It didn't. And that is what led me to becoming a certified financial planner and an AFC and deciding that I wanted to do coaching. I was like, there's a gap in this industry. Young professionals need to be able to understand their finances in a way that's meaningful. And since I couldn't find anybody to do it, I'm going to just, be the change you want to see sort of thing, which is very cliche. But and then along the way, like you said, I did 4 Olympic Games. So I am the first American woman to earn a medal in both the Summer and the Winter Olympics. I went 2004, 2008, 2012, and 2014 before transitioning off into life after sport, which was financial planning.
Oof. Well, work ethic is something we are akin to around these parts, and we can see you are welcome in our community anytime, Lauren. It really is an amazing story. And I love what you said about filling this hole in the financial industry for folks who don't just need the wealth management, but need those foundational pieces. Lauren is also an accredited financial counselor in like the list of things that she does. And I think that is actually an area that does really focus right on those beginning steps, setting up those good money habits. And that is a place where I think many, especially highly educated, well-paid professionals might be lacking. I certainly was when I went into law myself. I ended up, at a big law firm. I was making more money than most people in the United States, and I had no idea how to manage it. I was also raising kids by myself and trying to balance just like, life and law. But I didn't have that personal finance background, and it was so intimidating going out into the world thinking, gosh, I should probably be able to figure this out.
And it's so much pressure though, right? To just feel like you have to know it all. Like, I am a lawyer, I am smart, I am fancy, like I have to know how to do this money stuff. I just got off the phone with a financial planner who was looking for a financial planner for very basic financial things, because money is emotional. Despite the fact that we have like this education, like you said, and it's not, in law, it's not financial education. People who have financial education still need a financial professional in their life. So
Oh
yeah.
gosh, I thought it was bad for lawyers asking for help from financial professionals. I can't even imagine what it would be like to be a finance person asking for help with your finances, right? The imposter syndrome that would come in about your whole identity. Yeah, no, I can totally see that. So tell me personally, I think you went to school on a track scholarship, at least undergrad. Did you ever have to deal with student loans? Was this part of your life at all, or is this just something that you see with your clients now?
Yeah, this was not a part of my life. So I was very lucky in that regard. I went and got an MBA while I was competing during my time as a track and field athlete, and was able to pay out of pocket with that, a good track and field money. Financial planning doesn't pay as well. But once again, though, I was telling you that, sometimes things are born out of negative experiences. So my very first client that came to me kind of organically, because when you start a business, your friends are your clients, your mom's your client, everybody's the client. This young lady came and she had $364,000 of student loan debt and about $130,000 of income. And she was just so distraught because she was like, I thought that once I made six figures, my life was going to be okay. And we hear that all the time, that, a six-figure earnings is going to just like make a magic wand and something's going to show up and life is going to be great. She lived in a low cost of living city, Michigan, in Michigan, and was just really struggling with figuring out how to make the monthly payment on her student loans. And so I was like, oh my goodness, I don't know what to do. They didn't teach me this in CFP school. So I went down this rabbit hole of trying to figure out like, what the options were, what existed. And I ran into a young lady named Heather Jarvis, who's also a lawyer who's now, focusing on student loans. And I was like, okay, I learned something here. And by the time I got back to the young lady, because I said like, give me a little bit. And it was like 2 weeks. She was so anxious about her student loans, she had refinanced them. It was the worst thing that she could have done, which I'm sure we'll get to talking about today, but she owed 3 times what she was earning. And, not at my request at all, but just because she was so anxious, she couldn't wait. She went ahead and there was no turning back from that at that point. And so I just really wanted to learn everything I could to make sure that nobody else made a mistake like that.
Oh my goodness. I do think that, student loans are this very strange area of the financial industry because, there's so much talk about investing and, even within the FIRE community, the Financial Independence Retire Early movement, which was very instrumental in turning me into a finance person. But it's the student loan part that everyone gets tripped up on, because it's such a morass of information. And, just, in the past few weeks, there's already monumental changes going on, right? I've had to revisit a lot of conversations that I had with folks that might be in forgiveness programs. What is public service loan forgiveness actually going to look like? And, we can talk a little bit about that, but let's get into the meat of what we called you here for. We're so excited to have someone to help us walk through the tax strategies. I think this is really an area that doesn't get as much play as some of the other, more general talk about student loans and forgiveness generally, but there really are important considerations that people have to take into account when they're thinking about their student loan debt. And so tell me, when you are, working with clients, what do you want people to be thinking about? What kinds of tax issues should they be considering when they're in the repayment phase? When, they've graduated from school, they're faced with whatever their loan mix looks like, and, the last thing on their mind is taxes. But what should they be thinking about?
So the first thing I'll say is you need to know like what plan is appropriate for you, because some of the plans don't even take into consideration taxes. So if you have 100% private debt that you've refinanced with another company, your strategy is simply to pay those loans back, get them off your plate as quickly as possible. From a tax perspective, you may or may not be able to take advantage of the student loan interest deduction. But beyond that, and generally, like I said, if you're in a situation where you can refinance the loans, you're generally in a situation as well where your income is such that you're not even going to get the student loan interest deduction. So that's consideration number one, is like, what kind of loans do I have? What kind of plan am I on? Where the tax strategies usually come into play are for those that, decided to stay federal and decided to pursue some sort of forgiveness. First question that I usually get is married filing jointly or married filing separately. I would say that maybe 60% of the people who reach out to us are trying to figure that out because they heard a friend say that they're doing married filing separately. And they're just like, I don't understand the why behind it. I really want to do it though, if it's going to save me money on my student loans. So to dive into that a little bit more, it is, married filing jointly is the most advantageous way to, be seen on paper from the IRS standpoint and has the most benefits. Married filing separately is the least advantageous of the three options. Single would be the thing that's in the middle, if you will. And so married filing separately and single are not the same, which is, one thing to understand, is that you're not going to be in the same exact bracket as you would be, or the same exact, tax consequences as you were if you were filing as a single person. But from a student loan perspective, the thing that's important is that your income will be taken into consideration for whatever income-driven repayment plan you're choosing, whereas your spouse's income will not be taken into consideration. So that's the reason that you would want to do married filing separately. I'll pause there for a second, just to say too, that you need to, like I said, once again, know your plan. So we talked about refinancing, and then I jumped right into these income-driven repayments. Well, income-driven repayment is IDR, which is not to be confused with ICR or IBR.
Many plans. They have so many names.
It's awful, but also wonderful if you're on the right one. So IDR is the main program, income-driven repayment. And under that umbrella, you can choose IBR, ICR, repay, or pay as you earn. So if you're on one of those 4 different repayment plans and the payment is going to be tied to your income and you plan to pay for either 20 or 25 years, that's your strategy, then married filing separately may be appropriate for you. So that is the summary of how that works. If you're not on an income-driven plan, let's just talk about that real quick before we get to, because that is the meat of everything, is these income-driven plans and going for forgiveness as you think about your tax status. So if you're not on an income-driven plan, what might you be on? You might be on the standard repayment plan. You might be on an extended graduated plan, or extended plan or graduated plan, or there's a standard 30-year plan. There's one thing I'm forgetting here. So if you've consolidated your loans and you have over $60,000 of student loan debt, the standard plan becomes a 30-year plan. So those are your 4 other different options that are outside of the income-driven world. And all of those options are bad. So let me just tell you why they're bad.
Thank you. Thank you for saying that.
Important things to share. So the standard is a bad plan because it's going to put you on a 10-year repayment. And the federal interest rates are not going to beat private interest rates. So if you can afford to pay your loans back, you want to go ahead and save yourself money on interest by going with a private company. Now, the thing that people are always worried about when choosing standard versus, leaving for private is, what am I giving up by leaving the federal system? So like I said, you want to make sure that you have the income to be able to take advantage of refinancing before you do that. You are giving up that if you pass away during that 10-year time span that you're planning on paying the loans back, the federal loans would just go away. The private loans will be collected from your estate. So that's something to consider. We usually recommend that people get some term life insurance to be able to cover it, so it's not diminishing what you're trying to leave behind for others. The other thing from a private standpoint is that everybody's in this COVID forbearance right now. So if you're on one of those income-driven plans, you have had to been able to kick your feet up for the last 18 months and do nothing, and no interest has accrued. Well, the people in the private world have not had that luxury. And then there's forbearance and deferment. So each private company sets up its own way to be able to decide if they're going to let you do forbearance or some sort of deferment of their student loans. And they're usually a lot more stringent, maybe like 3 to 6 months. The most I've seen is like 18 months. But in the federal system, you get 3 years to put your loans on hold, which there's not really a reason that you should be putting your loans on hold in the federal system. Unless you're working on some other big consumer debt that you were trying to take up, like credit card debt or a personal loan, and you needed to take a break from the student loans to tackle something like that. If you have a drop in income, you're going to want to use one of those income-driven repayment plans we were just talking about, instead of using forbearance or deferment. That way you're getting credit toward a repayment plan while paying nothing on your loan. All right, I said a mouthful, so I'm gonna let you jump back in.
Yeah, no, I think, when we talk about tax strategies, like Lauryn was saying, if you're in the private loan sphere, the tax strategies are going to be the same as you would for any other debt repayment plan, right? This is just your typical consumer. This is private debt, and there aren't any real specialized strategies beyond what you would normally apply in any debt repayment plan and, financial planning generally. But in the federal sphere, there are all of these nuances that you want to be aware of. And even within the forgiveness plans themselves, some of them treat married filing jointly one way, and some of them treat it a different way. So it's not even, there's so much detail. And I remember I was meeting with a client, and I had to break the news to her that if she got married, her student loan payment may change. And I think it might have affected whether she wanted to marry her boyfriend, at least in the timeline that they were considering. Of course, it shouldn't be the only consideration, but I'm a financial person, so I want to make sure that you know what you're getting into. It's the cost of marriage. Perhaps you could see it that way. You just want to have the conversation and not be blindsided when it happens. But, Lauryn and I aren't here to give marriage advice, but we are here to give some tax advice, in thinking through, what kind of payment plan is going to be best for you. And so let's say you are in one of these forgiveness plans, you're on an income-driven repayment plan. What kinds of strategies can people employ, to help? What kinds of tax strategies have you seen clients employ to kind of make the most out of those situations?
And you teed me up so nicely. So those 4 repayment plans, revised pay as you earn, we'll start with. This one is going to be based on 10% of your discretionary income. However, if we're talking tax strategies, it's always going to take into account your spouse's income. So just as you were just saying, Jessica, it's like, if you get married, so-and-so's income is going to be taken into consideration. And you're like, wait, but what if I do that married filing separately? Well, this one, it doesn't matter. They still just calculate your payment. So that's one thing to know, is revised pay as you earn takes into account both people's income, even if you were to do married filing separately. Second plan is called pay as you earn. And these are the 2 most optimal ones: revised pay as you earn and pay as you earn. Pay as you earn is going to be a 20-year plan instead of 25 years, which is what revised pay as you earn is. And with the pay as you earn plan, you are allowed to do married filing separately. And so to your point, Jessica, what would happen is, let's say, as an example, you make $100,000 and your spouse makes $200,000. Well, if we do married filing jointly, they're going to calculate a student loan payment based on $300,000 of income. If we do married filing separately, they're going to make a payment based on $100,000 of income, and your spouse's $200,000 will be left out. So that's the reason right there that it makes sense, because you're like, with $300,000 of income, there might be a projection that says you need to pay these loans back, just get them off your plate. But maybe internally as a household, you're looking at it and your spouse is not willing to pay your student loans back. And overall, you need to be able to go for forgiveness. So this is where you would do married filing separately for the 20 years and get forgiveness at the end of that time frame. The other repayment plan would be income-based repayment, so IBR, which sounds like the IDR that we talked about earlier, but it is not. IDR is the program. IBR is one of the options within the program. IBR is going to be based on 15% of your discretionary income. So you're going to have a higher monthly payment. So if you have the 10% options, which is pay as you earn and repay, Why would I choose IBR? I never would. But you may not have those options, which is yet another thing to consider, which is why this is also complicated. So with the revised pay-as-you-earn plan, you need to have direct loans, and then you'll be eligible for it. But if you're trying to do Mary filing separately, you don't want to choose that one. With the pay-as-you-earn plan, if you want to be on that one, you need to have borrowed exclusively after October 1st of 2007. So if you had any loans before that time period, or if you took out loans, let's say you took out some loans in 2000 and you paid them back by 2004, and then you started law school in 2007 as an example, you would still be eligible for that pay as you earn. But you could have had no outstanding loans at the time you borrowed in 2007 to be eligible for the pay as you earn plan. So if you cannot be on IBR, if you cannot be on repay, and if you cannot be on pay, then you might need to choose IBR, which also allows you to do Mary filing separately. ICR is one that I mentioned. For those who are paying very close attention, there's not really a chance that you should be on ICR unless you have Parent Plus loans and you already consolidated them. Then you're stuck with that as a plan. If you have Parent Plus loans and you did not consolidate them, you need to get a student loan plan done, because there's options for you, but it's a lot more complicated than what we can talk about today. But ICR is not appropriate for anyone, and it's based on 20% of your income.
Yes, this is for old people like me who have loans that are so old. It was before the forgiveness programs even came out. And so we have been, struggling with the decision of, gosh, pay looks nice. Oh, I can't get into that. What about repay? I don't know if that's going to be helpful. Maybe I just stay in this old forgiveness program. But that is another reason, right, why student loan repayment strategies and figuring out what works for you has so many exciting twists and turns. Mm-hmm. Because at every juncture, you have to figure out, am I eligible, and does it make sense for me? And not only does it make sense for me now, will it make sense for me over the long run, over the trajectory of my career, the trajectory of my, financial journey, because so much changes, right, as we're going through.
Yeah, and that's so personal and customized. I think is a really good thing to bring up, is this idea. I just had one, actually it wasn't just recently, it was late last year, where the young lady went to brunch with friends, heard her friend got a great new interest rate, and her friend sent the referral link to get the great new interest rate. And she gave up public service loan forgiveness to refinance her loans because she was not wise about how it all worked and what was going on, and came to us a few weeks later, and it was already too late to undo what had been done. But it's, to your point, it's so important that you be creating a plan based on what your income projections are for the future, what your goals and your vision and your values are, and not based on what everybody's doing or what narratives are saying.
Yes, there are a few irreversible decisions in the financial world, but refinancing your federal student loans into the private sector is one of them. So please check with a professional before you decide to make that decision. That is my disclaimer on all student loan issues. But so this has been really helpful, I think, for people who, might be in the middle of a forgiveness program and thinking, or about to start one and trying to think through what kinds of tax issues should I be considering. The other, when you are in the actual repayment phase, there are some strategies that I've heard of in terms of, making sure that you are getting the best tax benefits, or lowering your student loan payments. What can you tell us about kind of how to make the most out of your student loan repayment journey if you're in one of these forgiveness programs where you actually have strategies to employ?
Yes, prioritize yourself is the best thing that you can do. So often people come to us and I can't pay my student loans because I'm never going to be able to save for a house. I'm never going to be able to retire. I'm never going to be able to, take care of my family. Fill in the blank about all the things that you won't be able to do. And honestly, what it is really like you deciding that your ability to save is more important than you being a stronghold or, feeling like you're enslaved to these student loans. So what I say is, think about lowering your adjusted gross income. So let's go back to that $100,000 earner. You can put $19,500 into your retirement plan on an annual basis. Who benefits when you put money into your retirement plan? You do. It's all about you. So wouldn't I rather, instead of making $100,000 on paper, drop my income down to basically $80,000 on paper? This lowering what we call your adjusted gross income, which is the number that they're using to calculate your student loan payment. So we lower the adjusted gross income. Now you pay Uncle Sam less taxes, which we all are trying to figure out how to pay less taxes, right? Use your pre-tax retirement account. Then second benefit is you're loading up your own retirement, because we all want to retire. Well, not everybody wants to retire, but you can. Some people don't want to retire because they just feel like they can't. And then the third benefit is that you're lowering your student loan payment, which is going to maximize the amount of forgiveness that you're getting. Which is kind of counterintuitive. People are like, oh, I don't want to pay less toward my loans. I'm going to continue to watch them grow. Well, if you're going for taxable forgiveness, that is the goal. It is to get to 20 or 25 years from now and the student loan balance be higher. You get that amount forgiven, but you were able to do things like save for your retirement, save for that home down payment, save for, your kids' education, because you were making financially responsible decisions that were to your benefit versus feeling like I have to put every single dollar toward these student loans and never getting to do anything you wanted to do or getting to save appropriately for yourself for retirement.
I think it's so important to remember the emotional side of debt. And sometimes, I have clients who come to me and their student loan balance has just been growing. And it's a stress that grows on their shoulders. But, when you actually see the numbers and you lay out for them what the eventual path looks like, that is the relief that they need to know, oh, yes, that's right. Keep my eyes on the ball, pay as little as possible, get the most forgiven, and then pay the taxes when I have to. Pay as little as possible, get the most forgiven, and pay the taxes when they come due. But it is a difficult mantra because it contrasts so much to what you see in the personal finance world, where all debt is bad, all debt is evil. If you're carrying it, you're a bad person, you're irresponsible, you should pay back your loans as some sort of personal responsibility contract that you gave with we're not going to get into that because that's
narratives.
A little beyond the scope. Let's bring Lauryn back for that conversation. But, this is the system we're working in. Why not work it so that you can actually have a life that you want and reach your other financial goals? So you mentioned tax liability at the end. Let's talk about tax liability at the end. And then we have questions coming into the chat. So,
I see we're getting loaded up over here.
Yes, we are. So let's get through that. Since you mentioned tax liability at the end, I want to make sure we have time for that. And then I'm going to pepper you with some questions that we've had coming in, and then we could go back to any additional questions we have from folks.
Yeah, and I also want to cover community property states too, as from a tax perspective. So from the tax liability at the end standpoint, is like I said, you get to the 20 or the 25-year mark. Whatever that remaining balance is going to be forgiven. So the IRS is going to say, hey, studentaid.gov is going to say, hey, you paid based on the way that we asked you to, based on your income. You still owe us $400,000. However, you don't need to pay us that $400,000. Now, the caveat is that you're going to have to pay taxes as if you earned an additional $400,000 in that year. So the important thing to be able to do is calculate, what kind of tax liability should I have? So you might as well just put yourself in the highest tax bracket, say, 35%, maybe you have some state taxes, another 5% there. So we're like 40% of that 400,000 is what I'm going to need to pay. And then you also need to figure out how to save that amount, or what amount to save in order to make that realistic. Because if you just focus on, oh my goodness, I owe $100,000 of taxes in 25 years, if you're not working with those numbers on a regular basis, your emergency fund is like $3,000 and your paycheck's like $6,000, you're just like $100,000, it's insurmountable to think about how you're ever going to pay for it. So what you want to do, how do you eat an elephant one bite at a time? You might need to save $150 a month. And if someone can do that math for you to say, this is how much you need to save for the next 25 years, you're like, oh, okay, my student loan payment's $300. I got to save $100 a month, and then I'll put that $100 a month. I got 25 years, so it's safe to invest that. It's a long term. You probably would invest pretty conservatively, but still you can put it away. And 25 years from now, you're going to have your $100,000 in my example. So it's all about thinking through what is necessary for you to be ready. The other thing I'll say about the tax liability is that it may go away. So as it's written right now, it's not going anywhere. So we say plan for the worst, hope for the best. But the reason that we think the tax liability might go away, one, like you said, we've seen a lot of changes on the horizon that have benefited student loan borrowers recently. But two, think about the number of borrowers there are, like over 44 million student loan borrowers, and the number of them that are using income-driven repayment plans. How many people are calculating their tax liability? How many people are saving for their tax liability? We know that most of America is not doing the basic financial things that need to be done. So they're going to get to the 25-year mark and say, someone's going to say, hey, you owe me $100,000 based on this amount that's forgiven, they're going to be like, wait, what? So if that, you multiply that times hundreds of thousands of people, that's going to have a big economic impact. And it's just not realistic for us to, be telling everybody, like, what are your options? File for bankruptcy, insolvency, get on another payment plan with the IRS for 10 years. Like, none of them are good. So we do believe that there is some sort of change on the horizon, and it's probably getting rid of that tax liability altogether. However, save for it now and be pleasantly surprised later.
Yes. Wouldn't it be nice to have a little extra bundle of money that you've just been putting away for years and you had planned on using it for your student loan tax liability, and instead you get to use it for something else? That's a win-win. That's great. And I do, I think thinking of it in such a, this really is a long-term plan, right? And when you break it down, it doesn't have to be so painful immediately. And look, the irony of not making enough money to pay your student loan payment and then being charged $100,000 at the end because you didn't have money to pay off your student loans in the first place. I mean, it reminds me of overdraft fees, right? Oh, you didn't have money in your account to pay this bill. Let's charge you extra because you didn't have the money the first time. Sorry, I'm going on rants. But yes. But yeah, so I am hopeful, and we actually had that question come in about the likelihood that there would be an extension of that limited suspension of tax liability for forgiveness, because we do now have some precedent out there that they can do it, and people might be into it. They kind of tested it on the smallest population possible because we just haven't gotten to the point where a lot of people have been in the program long enough to qualify. And I think it is interesting that for public service loan forgiveness, we are now at the point where more people could qualify if they had done things correctly from the beginning. But with all the miscommunication and all of the issues when the program was rolled out, those initial waves were all denied for often stupid reasons, right? Or understandable reasons. And now that so many people should have been qualifying and aren't, now there is a groundswell of support to fix that program. And so I think you are absolutely right. When there are hundreds of thousands of people complaining about this tax liability, when forgiveness actually happens, that's when we're going to see real changes come. But we won't know. So save. That's always the tip. And so tell me, Lauren, in terms of what kind of big mistakes do you see your own clients making with respect to tax strategy planning and student loan repayment strategies that, other than refinancing before you know whether that's a good idea for you or not? And then I'll go through the chat and make sure that we've hit everybody's questions.
Definitely. I would say the number one thing from a tax perspective is, trying to figure out how to cheat on your taxes. That is what we bumped into. Well, okay, you gave me this legal way to be able to do it. So like I said, we can do is lower our adjusted gross income by putting money in our 401k. You can also use like an HSA. Any other pre-tax deductions that you can get are going to lower your adjusted gross income. But business owners sometimes try to finagle the system. And then people, like I said, just flat out lie and try to do things to get their taxes lower. So don't do that. Do the things that are legal, that are tax strategy to lower your adjusted gross income. The other thing I mentioned previously was the community property state loophole. And so that's another cool thing that I've seen kind of be able to change people's lives. So let's go back to our $100,000 earner with the $200K spouse, and the $100,000 earner being the person with the student loans. So once again, let's say community property states are Arizona, California, Texas, Louisiana, Wisconsin. There's 9 of them. So look up the community property states. And what happens with the community property state is this person has $100K of loans. So once again, if you do married filing jointly, it's going to be $300,000, and maybe that results in you paying your loans off, depending on what your loan amount is. However, in a community property state, when you do married filing separately, it's not just 100 and 200 as in our previous example. They add your income together and then they divide it down the middle. So that's 150 on your side and then 150 on your spouse's side. So now your spouse's income has gone down and your income has gone up. But you're like, well, at least I'm not paying based on 300,000, but I only make 100. So why am I paying based on 150,000? And that's what you would do if you turned in your tax return. However, what you can do is submit what we call alternative documentation. So that's more like a pay stub or some other document that is going to prove that, hey, I only make 100,000, even though my tax return says I make 150. Could you please calculate my income? My student loan payment based on my income instead of this 150K. But you have to do the married filing separately as a prerequisite to be able to get the lower payment based on just your income.
Wow. So does that work in the opposite direction? If the person with the student loans actually has a high income and a spouse with very low income, they can slash their own income practically in half to be able to lower their student loan payment and then not file the extra form because they like the way that the math worked out.
You are picking up what I'm putting down. Absolutely. So now this student loan borrower has 200K and their spouse is a 100K earner. Same thing, 300,000, married filing separately, 150 each. Well, now my tax return says 150 instead of 200. I just want to turn in my tax return. That is not illegal. That's strategy. Like you said, not things like just making up something on your return altogether. We don't want any fraud, but that is strategy. And then, yeah, that's what we call the breadwinner loophole. So you can, like I said, once again, from a life goal standpoint, some people feel strapped to the student loans. You want to have your spouse stay at home. Well, you can have a stay-at-home spouse that has zero income in a community property state, and now you cut your income in half on paper because now you're giving half of it to your spouse, and ta-da, your payment is a lot lower based on that income.
Oh, I'm sorry, I could geek out on this all day. Okay, let's get to questions from the chat because they are flying in. We had a question about if you switch from one income-driven repayment plan to another income-driven repayment plan. So for example, from repay to pay, does that start the clock over for the forgiveness timeline?
That does not start your clock over, but it does capitalize your interest. So as long as it's the right thing for you to do, it's not the biggest deal for your interest to capitalize, but you do want to be mindful of interest capitalization. So what I mean when I say that is maybe you owe $200,000 of student loan, and over the course of the years, being on an income-driven plan, another $50,000 has accrued. That $50,000 is sitting in a separate bucket, and not recertifying your income on time, moving from one repayment plan to another, consolidating your loans, or going into a forbearance or deferment are all things that can cause that $50,000 to jump into the $200,000 bucket. And now you're paying interest based on $250,000 of debt instead of just $200,000 of debt. So you can keep the timeline by switching from one plan to another, but you just want to be mindful of the interest capitalization, and there's no way to avoid it. So you want to make sure it's the right plan if you're doing that.
Right. And changing the nature of your loans, like doing a federal consolidation loan, used to have an effect on your public service loan forgiveness timeline, which is where I think some of these fears come up, because there are issues about switching plans or switching loans and having it affect your forgiveness timeline, but not if you're going from just one income driven to another income driven. But those are great things to watch out for that Lauryn mentioned in terms of the interest capitalization. Okay, do you have any experience with federal loan service providers ever renegotiating the applicable interest rate? I know, I'm like, I don't have any. It's literally in the promissory note. Like, what your interest rate's gonna be.
It's not a thing. Yeah, and people also want to like negotiate like a payoff. Like, what if I just give them like 15 grand? Maybe they'll be okay with it. Like, also not a thing with the federal government.
Yeah, those are very rare, and we are starting to see individual cases coming out in particular states that have friendly bankruptcy laws or, friendly consumer protection laws, but it is by no means the standard. And the federal government seems to be taking a stance that they don't want to take any of those cases to court because they don't actually want precedent. So they settle it out of court, give someone who might be a compelling victim in this case of student loan debt, and they give them a settled amount. But the punishment of going through that and really basically having to become bankrupt in the process, right, to be able to make that case is often not where a lot of folks want to end up. But yes, federal interest rates kill people, and that it will remain that way. There actually isn't a salve for that. We actually did talk about recertifying income. We had a question about when is the optimal time to recertify income for the upcoming reinstatement of loan or interest payments. I imagine that you guys have gotten questions about that over at Student Loan Planner.
Yeah, and this is a tough one. So the last guidance that we received was that they were going to roll your payments to the following year. So all during COVID. So let's say, as an example, your recertification date was June of 2020. You did not have to recertify your income in June of 2020 because of COVID. So you could have just done nothing instead of giving your income, and you would have, picked up in June of 2021 with a new repayment at that time. They would have said, hey, this is your new recertification date. And assuming that we would have gone back into repayment, you would have started paying based on your new income in June of 2021. We are not sure 100% what they're going to do when we get back to repayment in February. You'll pick up where you left off, but whether or not they're going to ask you to recertify, some of the servicers have already started reaching out asking people to recertify. So it's not clear via like studentaid.gov that they're going to roll every single person over. So if your recertification date, as an example, is this December, they may ask you to recertify this December. Whereas previously they were saying like, oh, it's this December, we'll roll you over to December of 2022. And that would be the first time that you recertified your income. So you may pay all of 2022 based on like 2019's return because you haven't recertified in so long. So it's not 100% clear on which of those things they're going to do. But if you can keep your old recertification, assuming that you were making less than you're making now, then it makes sense to do so. If at any time your income goes down, you want to recertify so that your payment can go down if you're pursuing one of these forgiveness options.
I do like that, when you recertify, it counts for a year unless your income goes down, but you don't have to recertify if it goes up. So so anytime your income goes down, recertify, and then don't recertify again if your income goes up until you absolutely have to.
Wait 12 months.
That's right. These are the strategies that people need to know. So good questions coming in. Let's see. If you are late on a payment, how does that affect the calculation of years of qualifying payments for forgiveness? Does it restart the number of years or just add another payment?
Adds another payment. Yeah, it doesn't start you over from scratch for missing a payment.
Yeah, and with respect to the public service loan forgiveness rehaul that they're in the process of rolling out, there's been a lot of complaints that people were not getting credit for payments that were off by small amounts. They missed it by a couple of pennies or something like that. And so the servicer did not count that as an eligible payment for the public service loan forgiveness program. They are trying to fix that. So if you have, some payments where you were off by a little bit, you want to make sure that you're getting credit for those when you are counting up how many eligible payments you have going toward your public service loan forgiveness. Let's see. Oh, we had a bad servicer giving bad information. Uh-oh. Someone was told by their servicer that switching to another income-driven repayment plan would restart the clock over. What are your recommendations for fighting this type of misinformation when dealing with these service providers? You mean other than them being all fired by the department, you're just walking away from servicing loans?
Well, and because this is a group of lawyers, digging into the fine print is what I think a lot of you do for a living. Studentaid.gov has all the information. So if you really feel like something is not quite right, one thing I would always ask is to escalate to a manager and see if you get a different answer from escalating to a manager. If you're pretty sure that what you're calling with is correct. And then if you're not 100% sure, or even if you're sure and you want to be able to state it, studentaid.gov has, like I said, all the information. So you got to kind of sift through and say like, okay, where do I find this specifically? But that's the hardest thing that we've encountered is, like you said, someone comes back to me and they're like, Lauryn, you just told me to do this. And now the servicer says I can't. And I'm like, well, the servicer is wrong. It's counterintuitive because they're the people who are servicing your loans, who are employed to take care. And you assume that they're supposed to be doing what's in your best interest. That's not actually true. They're actually just trying to, make a living, read from a screen. Some of them, take their job very seriously and have invested a lot of time. But in general, they're trained by the hundreds, they're not paid well, and they have no financial expertise. So it's far more likely that you're going to be coming to them with the right information and they're going to be giving you the wrong information than it is for it to be the other way around. So trust but verify is the kind of best case scenario for that.
Oh, and we did want to make sure that we clarified which forgiveness plan, which IDR plans, income-driven repayment plans in the forgiveness program have the married filing separately benefit, or at least some sort of strategies that you can employ.
Yes, so that would be the pay-as-you-earn plan, the income-based repayment plan, and the ICR, though I don't recommend ICR. So it's either pay-as-you-earn or IBR as the two options for married filing separately.
Oh, this one looks very complicated. Let me just read it because otherwise I'll get it wrong. For Perkins-Stafford loans that were consolidated into a direct loan consolidation, does the consolidation itself restart the clock for the payment terms that go toward forgiveness? So if you consolidated after 7 years of paying towards those Perkins-Stafford loans and then turn them into a direct loan, does the repayment clock restart?
Yes. A consolidation always is going to restart your clock, because with a consolidation, you're effectively making a new loan. So you've gone, like, even though it's in the federal system, and this is another thing that gets confused quite a bit, is refinancing versus consolidating. Consumers use those terms interchangeably, and in the student loan world, they're not interchangeable. So consolidating happens in the federal system, and it's taking all the loans that you have at studentaid.gov and squishing them down into one or two loans. So you'll see direct consolidated subsidized, direct consolidated unsubsidized, assuming that you have both. That's creating a new loan within the the federal system, and your interest rate is going to be the weighted average interest rate of all those loans. They're still federal loans, they still have all the federal benefits. However, you created a new loan within the federal system. Refinancing, on the other hand, is taking either your federal loans out of the federal system and putting them with a private lender, or taking your private loans and refinancing them to get a lower interest rate. That is all private, and that's completely separate of consolidating.
Yes, people think that when they consolidate, they'll get a new and better interest rate. And it might look that way on paper, but that's because you had loans that were all across the board with interest rates, but you're really going to end up paying the same amount across the time period. They figured that out already.
And Lisa, this is where back to those, like, the oldies but goodies. So way back in the day, it was a thing. Because there were variable interest rates. So they had to figure out how to lock you in when you consolidate it. And so a lot of people are like, oh yeah, I remember when, they told me to consolidate so I could get a lower interest rate. And I was like, that's not a thing. And then, I kept getting it, and slowly but surely I was like, oh, okay, this is exactly what they were talking about. Like, you had some old loans, because right now federal only gives fixed rate interest rates.
Mm-hmm. Ooh, questions about opportunities to potentially lower or get a reduction in your federal interest rate. If you sign up for things like timely payments or automatic debit, is that something that is often offered by the federal service providers?
So some of the federal service providers will do like a 0.2% interest deduction for, like you said, going on auto pay. But ultimately, like you said, it doesn't help if you're going for forgiveness, because there's going to be something forgiven. So, I mean, I guess overall you pay less interest, and you might have a lesser amount forgiven because it grew a little bit less. But a 0.2% of a 0.2 of a percent doesn't make that huge of a difference. And like I said, ultimately, if you're going to be paying the loans back, unless you're like incredibly debt averse and you're choosing like, okay, I got $20,000 of debt to pay back, but I'm just really terrified of going private, or I think the government's going to swoop in with their cape and forgive all the loans, so I want to make sure I keep my loans federal. You can take on that risk and stay at a higher interest rate. But that's where it would, definitely make sense to use something like a auto draft and get rid of your 0.2%. But ultimately, you shouldn't be in the federal system. It's not that you shouldn't care about the interest rate, because the interest rates are crap and we need to do something about it. But if you're going for forgiveness, it's kind of like you shouldn't care about the interest rate. You just need to maximize your forgiveness and pay as little as possible toward your loans.
Ooh, okay, good question. Are there tax credits for paying student loans versus the liability that you refer to if your loans are forgiven? So I'm not sure if we talked a little bit about the student loan interest deduction, and that, a lot of people certainly in the legal space might not qualify for it at the end of the day. But for those that do, are there any other types of tax credits that you can get for having paid toward your student loans?
There are none that I am aware of. So yeah, tax credits are different than the liability. The liability is what you need to pay. Like you said, at the end of it, you want to, definitely hire an accountant in the year that the forgiveness comes. So you can also, I always talk to people about taking like a sabbatical, because it's like I said, in my example is like, oh, 400K is forgiven. Maybe by that time you're making 300K or something, now we're paying based on a 700K income. It's like, okay, maybe this is the year I don't earn anything, so I can pay less taxes overall.
Now that is some advanced and important tax planning strategies that you want to pay attention to. I think a lot of us have conversations with folks who it feels like forgiveness is so far off in the future that like just put it away, just put some money away, and we'll deal with it a little bit closer to when it actually happens. But just like with every other tax planning strategy, there are things that you could implement, close in time to losses that you might be able to carry over, right? Things to start thinking about if you do anticipate having a large tax bill that you're going to be responsible for. And that is so far outside my wheelhouse. And that, I think, is probably where people might get a little too creative. And you definitely want to be working with someone who knows what they're doing if you're trying to avoid a $100,000 tax bill. That's going to raise some red flags with the IRS. You want to be careful.
And I see Jamie jumped in too and said that state tax credits are something that, so you have to know like what the rules are in your various states. And there's tons of different things, and even forgiveness programs that are starting to come out with various states, and people states trying to coerce people to move to them and, do some sort of student loan opportunities there. So lots to look into in that regard.
Oh, excellent questions. What are some books you would recommend on student loan repayment strategies? Do you have any books other than, I send everyone to the Student Loan Planner website for or my blog. You can check out my blog. I have, good strategies on there and what you should think about. But, other than those, are there places where you send clients or where people are looking for more resources can find more information?
Yeah, student loans are so new and so nuanced that I don't know that even a book, like if it's 3 years old, it's probably outdated. So we've never come across a student loan book, but like you said, studentloanplanner.com is the website, and there's blogs there and they're being updated constantly. So like I said, we are dedicated to making sure that we're staying on top of what's going on. And it's not a book, but you can even search by topic. So like, why get a book when you can read a chapter that's relevant to you, sort of thing. I think that's relevant. But to learn all of this, I know the AFCPE, when we did our coursework, they had like a chapter about student loans in it, but there's not like a student loan book.
Yeah.
Studentaid.gov would be probably your other good option, because like I said, that is all the rules and all the, the jargon and the long laid out stuff.
Yeah, I think studentaid.gov really is one of the best federal websites for information. They have, they have decision charts on there of like which plan might be the best fit for you. There are a lot of powerful resources, but then you want to take what you've read there and maybe ask, someone that works in this space to make sure you're interpreting it correctly, because sometimes it can be a little confusing when you're going through the site. But they do have a great frequently asked questions section that I have used to try to help my clients understand what's going on with their own personal situations. And of course, the Student Loan Planner is great for all things student loan related. But Lauryn, before we close out for today, tell us, where can we find you? I'm going to be including links to your website in the show notes that are going to go out with this recording. But tell us, where can people find you and where else can they get more of Lauryn?
So you can find me at studentloanplanner.com if you're looking for a student loan plan. I am one of 6 consultants. I usually work only on Thursday. So if you're interested in working specifically with me for a student loan plan, you would need to book on a Thursday. Otherwise, you can find me on all the social media channels. So at Lauryn C. Williams, I spell my name with a Y, so Lauryn. And my company is called Worth Winning, where I do, like I said, comprehensive financial planning for young professionals.
Excellent. Well, I'm going to take one last call for questions from anyone in the audience. We covered so much information today. Lauryn, this was so awesome. It's rare that I get somebody on here who loves student loan planning as much as I do. And so it was really fun getting to geek out with you on all these different strategies.
And you're so easy to talk to because you're so knowledgeable. So, sometimes it's generally like all questions at me, and it's like you filled in with the great information. I'm like, oh, she is an expert. Yes, bring the knowledge and the expertise.
Student loan repayments are the bane of my client's existence. But law school is just like a completely different animal of student loan debt. And so, yes, we've done a lot of work in this space, trying to get people, both, number one, understanding what's going on and just not being so scared of it, right? And figuring out we can come up with a plan that is going to fit into your overall life. And the plan doesn't have to be pay off your loans as soon as possible. unrealistic for most people, and not very good for your overall financial health. So, this has been so wonderful, Lauren. Thank you so much. Again, you guys can all catch the recording if you missed anything, but thank you so much for joining us on this Zoominar, and we will be looking for you in the interwebs. Goodbye, everyone.